It's a typical Tuesday morning. The market opens, and within minutes, everything crashes. Stocks you once trusted are plummeting, and panic sets in. News outlets are blaring "market crash" like it's the end. But for you, this is an opportunity. While others panic and sell, you'll know what to do. You'll be ready to seize the moment. Welcome to Mastering Investing During the Next Stock Market Crash. Welcome to Sage Investing, bringing you timeless investing wisdom. If you're looking to improve your investing knowledge, make sure to subscribe and hit the like button if you found this useful. Let's face it, crashes are inevitable. They've happened before, and they'll happen again. The dot-com bubble in the early 2000s, the great financial crisis of 2008, the COVID crash of 2020. The common thread between these events? Millionaires were made. Fortunes were built in the ashes of those collapses. So, how do you turn chaos into opportunity? That's what we're going to dive into today. You'll learn 3 key strategies that will position you for success in the next big market downturn. So let's get into strategy number 1. Have a cash reserve. I can't stress this enough. Liquidity is crucial during a market crash, and there's nothing worse than watching a fire sale on stocks while lacking the cash to take advantage of it. How much cash you hold as a percentage of your portfolio is a personal decision, but a good rule of thumb is to keep 10 to 15% in cash or cash equivalents, like money market funds. This way, when the market crash comes, you won't be scrambling to sell your other investments at a loss. Your cash allocation should reflect your risk tolerance. Holding too much cash can mean missing out on potential gains, especially if the market continues to rise. And remember, the market rises more often than it falls. Conversely, keeping too little cash may limit your ability to capitalize on those bargains when the crash eventually arrives. Remember, no one can predict the timing of the next market crash, but being unprepared could cost you in the long run. Strategy number 2, build your watch list. During the frenzy of a crash, emotions run high. Fear, uncertainty, doubt, they cloud judgment. That's why you need to do the homework now, not when everything is falling apart. Identify 5 to 10 companies that you believe in for the long haul. Companies with strong fundamentals, competitive advantages, and, most importantly, a track record of weathering storms. Think of names like Apple, MasterCard, or Berkshire Hathaway. These are companies that have survived and thrived through multiple downturns. These companies are not only the hottest stocks when the market's booming, but they will be the pillars of your portfolio when the storm passes. A well-researched watch list helps you avoid the trap of panic buying risky stocks. Stick to quality, and you'll be rewarded. Strategy number 3. Embrace dollar cost averaging. This is the one that separates the smart investors from the amateurs. You've heard the saying, time in the market beats timing the market, right? Well, that couldn't be more true during a crash. What you need to understand is the difference between speculation and investing. Speculation is trying to pick the exact bottom, which is nearly impossible. Investing is about recognizing the value of great businesses when they're temporarily undervalued. And in a crash, those opportunities are everywhere. By spreading out your buys over weeks or months, every time the market dips, you're buying more at cheaper prices. This smooths out your purchase price and takes the emotion out of the process. Let's illustrate this with an example. Suppose you're investing $1,000 a month. In month 1, the stock price is $100, so you buy 10 shares. In month 2, the price drops to $80, allowing you to purchase 12.5 shares. By month 3, the stock crashes to $60, and you buy over 16 shares. At the end of 3 months, you've invested a total of $3,000 and acquired approximately 38.5 shares at an average cost per share of about $78. Now, let's explore what would happen if you attempted to time the market and invested the entire $3,000 when the price first dropped to $80. In this case, you would have acquired 37.5 shares, resulting in an average cost of $80 per share. However, when the stock subsequently fell to $60 per share, you'd be left with no cash reserves to take advantage of those lower prices. This illustrates why timing the market based on a single drop often doesn't work. Market timing is notoriously difficult, and by dollar cost averaging, you not only reduce your risk, but you also increase your potential for gains when the market eventually recovers. It's a simple strategy that keeps you from making emotional decisions. When everyone else is panicking and selling, you're calmly accumulating more of the companies you believe in. But there's a catch. None of these strategies work unless you have patience. The market doesn't recover overnight. It might take months or even years. But historically, the market has always bounced back. And when it does, it rewards those who were prepared. So to recap, build that cash reserve now. Prepare your watch list with companies you trust, and embrace dollar cost averaging when the time comes around. Remember, crashes aren't something to fear. They're the moments when the market hands you opportunities on a silver platter. And if you play it right, the next crash won't be a setback. It'll be your chance to build lasting wealth.